We're back. Welcome, everyone. We're back with Fraser Lang, who participated in one of our webinars. I guess it would have been back in November, and we talked about the individual pension plan. Now, today's topic, we're going to talk about something a little different. You know, with all the tax reduction strategies out there that are basically going away because of the government, there's still a few left. And one of those tax reduction strategies would be to use something called a retirement compensation agreement. So welcome back. I'm going to let Fraser introduce himself so you all know who we are. So Fraser, introduce yourself.
No problem. My name is Fraser Lang. I'm the head of sales for GBL. We're a third-party actuarial firm that has worked very close with Sheean and Patel through the years. We bill clients directly for the work we do. We don't deal on the investment side, but we are an actuarial firm that we provide consultations with regards to tax planning and how certain strategies would fit. We do all the legal documentation, administration, and tax filing. So all the boring stuff that other people don't necessarily want to do, but is necessary. And we try to make it obviously as interesting as possible.
Yeah, sometimes it's a little difficult because tax is boring, but you guys do make it a lot of fun.
Well, taxes are always boring until you get your notice of assessment, and then it's something that's very real to all of us, isn't it?
Yeah. Oh, yeah. Everybody likes to get that dollar amount back from the government. So why don't we jump into some questions here? So why don't we just kind of touch on the most basic? What is this retirement compensation agreement?
Sure, no problem. So an RCA, or retirement compensation arrangement, is a supplemental retirement plan. We saw these come into effect back in around 1986. It was actually a punitive measure at the time where they would look at structures that they felt weren't on side and they would turn it into an RCA. And it's interesting from that perspective because we do see these now used more as a tax planning tool, where the idea here is that the monies that are contributed to the plan are deductible to the company, not taxable to the individual, until they draw the money out in retirement, and they've got full flexibility as to how much they take out. There's no age, like an age 71 or 72 rule where you'd have with either pensions or RSPs, where you need to draw the money out. And really the idea here is we're taking money that would be taxed at a very high rate. It's funded into the RCA. Half of it is funded into an investment account, which is invested accordingly. The other half sits in a non-interest bearing account with Revenue Canada called a refundable tax account. And when you draw the money down, half of any withdrawal is going to be rebated back from that refundable tax account. So half your money's not growing, but the idea here is when you actually take money out of it, that you're managing other taxable income, hopefully pushing that to the side so that you can knock this down a bracket or two. And that's really where the big advantage on it sits. It is very flexible in terms of design, so we can adhere the documents to different situations, whether it's an executive compensation program where maybe people want things like vesting in to tie client, executives to the company longer term. It can be used in a severance situation, and it can be used in a lot of situations involving business owners where they may need to be down below what they call the $500,000 small business deduction limit. They might be bonusing to get to that level, and they don't actually need that bonus. So rather than taking taxable income they don't need, what if we could instead redirect monies into the RCA, which creates a deduction and helps clean up the corporate book so they pay a lower corporate rate?
Yeah, that sounds like to the average listener on the line, I'm sure this sounds really, really complicated, but that's why we have people like Fraser. And at the end of the day, it's about saving on taxes and avoiding being that high rate of tax. So let's just step back a little bit here. You kind of touched on it. Who are the ideal candidates for something like this? Because I know not everyone would be the ideal candidate.
I think when you're looking at it, the main thing is the money that would be contributed to the plan. If I didn't have an RCA and contribute to it, what would be the tax rate I'd be looking at? So I think you're really looking at people probably earning on average, 150,000 plus. The closer they are to that top tax bracket of 220, is where you see more of a deferral opportunity sit. I mean, it's not a hard and fast rule. We have set these up for people that are earning, less, a lower annual amount, but perhaps, they've been with a company for 20 years and the company wants to do well by them in terms of some form of a retirement payment, and we can create the significant room. But I think if you're looking at it just on a case-by-case basis, you're really looking at people that have either a one-time or periodic or annual tax liability they're trying to offset, and they're already paying themselves up to one of the higher tax brackets.
Right on. So is this, did you say bonuses as well?
Yeah, and I would say bonus more in the sense of the business owner, where they don't have a defined employment contract and they're just paying out certain, they have to pay out certain active income to offset, the active income in the corporation. And so it's a bonus, but it's not necessarily something baked into an employment contract.
Got it. All right, so let's just move ahead here. I don't see any questions. If you do have any questions, feel free to write them in the Q&A screen there, as you can't ask them live, but I can ask them for you. Let's go on to how do we structure this? You kind of said something about a refundable tax account and an investment account. So let's just talk about how this RCA, or retirement compensation agreement, works.
Okay, sure, no problem. So the RCA is established at the corporate level. So the company would agree that we're establishing a retirement compensation arrangement on behalf of, employee X. So what happens there is we provide the documentation to create what we call an RCA trust, or we can refer to it as the investment account, just to not have too many technical terms running around. And we look at using a pension calculation of their best 3 years earnings, the number of years they've been with the company for, and their age. And we say, based on this, here is the upper limit, or how big the box is for the RCA that you can fund. You can fund as much of that as you like. It could be a minimal amount, it could be a periodic amount, it could be a one-time funding amount. There's no obligation to fund anything beyond, unless it's in an employee's contract that we're going to fund X dollars. There's no requirement to annually fund it or fund a specific dollar amount. So then what we do is we apply for the government for what we call, with the RCA unit at Revenue Canada, where we have established something called a refundable tax account. So in this example, pardon me, the company wants to contribute $100,000 in total to an RCA. We establish the plan. You open up the investment account. The company then writes 2 checks, one for 50% of the contribution, or $50,000, to the investment account where that is invested, and then the other $50,000 goes to the refundable tax account with CRA, where it sits in escrow. The idea there is, obviously money in the investment account grows over time. I retire and I want to take, $20,000 out of my RCA. $20,000 comes out of the investment account minus withholding tax, and obviously I'm taxed on that based on my overall income in that given year, and that tax rate would be income rates just like you'd have with a pension. Unfortunately, you can't income split it though with the spouse, so that is one difference we have here. So the money the $20,000 comes out of the investment account. We do a tax filing with the government saying a $20,000 withdrawal has occurred. They write a check for $10,000 from that money that they're holding on behalf of the member, and it goes back to the trust account. So the idea here is, for every dollar you pull out, you get $1 back, or you get 50 cents back from refundable tax, and then you're taxed at the overall rate at that point.
So just so we can take a step back here, the corporation is writing the contribution into the RCA. So the contribution from the corporation, is it tax deductible for the corp?
Yeah, it's a pre-tax corporate deduction.
Okay. And then for the person who's receiving it into their RCA, they're getting how is that on their income? So if you have $100,000 that goes into the RCA, the corporation is taking a deduction, and then the person, is it added as income, or how does that tax?
It's not considered a taxable benefit. It would just be a deductible, a pension expense to the company, and not taxable to the individual. Now, you can get into situations where, let's say we had a non-shareholder executive where we're putting them in here and the company says, okay, we're going to set this up, but we're going to have an employee match where the employee has the ability to match up to 100% of what the company puts in. In those scenarios, what they usually do is they'll write it down as a bonus on the books, taxable bonus to the executive. They don't take any withholdings. They redirect that amount to the RCA, and the individual will actually get a personal tax deduction for their portion of the contribution. So it is actually reported on their T4 slip, and that deduction offsets the tax they would have paid that hasn't been withheld.
Cool. So I guess let's talk about, we've kind of touched on some of these benefits of having one of these things. Can you have an IPP or an RSP at the same time as having an RCA? Is that allowed, or is that not heard of?
Yeah, I mean, first touching on the RSP side, there is no pension. So when you're in a pension plan, there's usually something called the pension adjustment, as you know, Sheean.
Yeah.
IPPs we've worked on in the past, where it reduces all but $600 of your going forward room. There is no pension adjustment with an RCA, so it does not impact your RSP room. So you would still be able to make your full RSP contributions, even if you're fully funding, your portion of the RCA. That's not subtracted from that. We can do an IPP where we layer an RCA on top of it as a supplemental side, but what happens there is we have to subtract the income that is being used to calculate the IPP portion from the 3-year average that we have. So you could do it, but you're probably looking more with individuals, where their T4 earnings are, let's say, $250,000 higher, where the IPP takes care of the 162,000 of T4 up to the max this year, and the RCA room would be based on the excess amount above that.
So like 100,000 or 90,000. Yeah. Okay. Got it. So then let's just talk about, I think you touched on it too, is contributions to the RCA. Is there a limit?
Well, once again, the limit is going to be based on, it's not like RSPs and IPPs where the limit's at the 162,000, the money purchase limit. The higher your 3-year average earnings are, the higher the amount you can put into the RCA. So there is a limit. That limit, as I mentioned, is going to be based on a pension calculation where we look at their 3 best average earnings, how long they've been with the company, and their age, and we take a forward number and we say, here's what can be funded, the maximum that can be funded into the plan.
Cool. Why don't we touch base on estate planning?
Sure.
And how one of these things could be used for estate planning. Say you've got an executive, has more than enough money to live on, and wants this bonus or whatever they're putting into the RCA to go to family. Is that possible?
Well, what's interesting with the RCA is because the rules that oversee it are very broad-based, unlike an RSP or a pension where there's very defined rules in the Income Tax Act. There's a couple things you could do there. First off, if it's a case where it's not a family business and the kids aren't on the payroll and we've got an executive and they've got money in the plan, and as I mentioned earlier in our discussion, there is no age that you have to start taking money out of the RCA. So technically you could just defer it through your lifetime if you don't need access to the money. The spouse would automatically be the beneficiary. If the member dies and the spouse is already predeceased, if they have adult children, we can have them as adult children in equal shares where they can draw the money out in equal amounts over whatever length of time they see fit. So what's nice here is when we're looking at estate planning, if the individual has RSPs, that's all going to be, a tax liability at that point. Whereas here we can manage that liability. The other side is if you do have a bona fide family business, we can add if the adult children have been receiving T4, we add them to the plan, and there's a full deferral when the parents pass. The assets just flow down to them, and they've got full control over when they take the money out and how much. So there is a really strong estate planning side to RCAs that we don't necessarily see with other pension structures.
Got it. Okay. Well, that's very interesting. Let's move on to, I don't see any questions coming in yet. Okay, so let's just go on to another question here. Can the RCA be used for, you were talking about employee severance. So how is it working for, so I'm an executive of a company, they're letting me go. How do we get this all set up so that my severance of, say, $1 million is in the RCA?
So what we would do there is, now this is assuming that the severance hasn't been signed off and agreed to, that they are still in a negotiating phase with it. And it's also going to be predicated on the fact that the company is willing to establish and one-time fund the RCA on behalf of the individual. So rather than, taking your $1 million example, rather than it's $1 million payment that is taken into tax, that is subject to a 53% tax rate, where over half the money is going off to CRA in tax. If the company is willing to write the agreement as such that instead of a severance payment or salary continuance, that they are providing a retirement payment to a retirement compensation arrangement on behalf of the individual, then what we can do is have that $1 million funded into the RCA, half in each of the accounts. The way that it is structured is the company has no involvement with the RCA once it's funded. So once they've done their portion and the individual has ceased employment, the trustees take over the plan. There's no further obligation by the funding company, and any administration costs on the RCA can either be billed directly to the severed member or taken from the RCA assets, so it's a little more tax efficient. At that point, once it's funded and they've ceased employment, they would have full flexibility as to how much they take out and when they take it out. So it could be a situation where you have, let's say, someone who's 60, they get $1 million, they can push their RSPs and CPP out, farther down into the future. And let's say over the next 10 years, they draw, $125,000 a year of income from the RCA. At $125,000, you're only attracting a 28% tax rate. So you can imagine going from 53 down to 28, you've got a 25% spread there in terms of the tax rates. And that's where the really big advantage is that exists.
Yeah, that's huge. You can save 25% on your taxes. That's amazing, right?
Yeah, I mean, it's $250,000, right? I mean, it's no chump change.
So I guess this is actually kind of interesting. So what if you're like LeBron James and you just signed another $10 million deal and they give you an upfront, extra few $1 million? Can you put that extra bonus into something like this?
Well, it's interesting because in the Income Tax Act in Canada, they actually have, so one of the things you have to be wary of for a normal employee is something called a salary deferral arrangement. So I have in my employment contract that I'm going to get X amount of dollars as a bonus paid through payroll deductions. If all of a sudden that went away and there was a corresponding RCA contribution, CRA could come back and deem that what we call a salary deferral arrangement. With athletes, however, and artists, there is a special section of the Income Tax Act there that allows amounts from their contracts to go in without it being deemed a salary deferral arrangement, as long as it's deemed to be reasonable. Unfortunately, it no longer works for the NBA because a couple collective bargaining agreements ago, they no longer allowed for RCAs to be implemented. But let's say pick any member of the Leafs that's making a lot of money, for example. What you can do there is you can establish the RCA where it's funded on each payroll. Every time you would receive payroll, whatever you want to instead have redirected to the RCA, the team would actually, at the payroll level, redirect that, the 50-50 to the government and to the trust account on their behalf, and it's reduced their taxes at that point. And of course, because a lot of athletes have much shorter careers than we have in other areas, it gives them this great opportunity to then be able to use that money when they're changing careers after their playing career ceases. And where it fits really well is, I mean, obviously we have the Connor McDavids and Austin Matthews of the world. And I mean, Matthews, I think if he ends up back in Arizona, there's a very good deal there because there's no state taxes and you can draw it down to a 25% rate, as low as 15 in non-state taxes if you're drawing it out over time. So there's a huge advantage there. But I think where you see it is where you have people that are, let's say, the $1 million mark. Maybe they're low, lower on the, and they're a bit older. So maybe they're in their late 20s, and really they know that this is one of the last contracts they're going to receive, and every dollar at that point really matters even more so for them, because it is their nest egg for retirement. And in the later years, they might just set up an RCA and fund the majority of their pay into that RCA, so that can help them, if they wanted to go back to school or whatever, to retrain for the next segment of their career. It gives them the capital to do so.
Oh, fantastic. So there's something about selling of shares of a business and using an RCA. So say I own a company and I own 25% of this company, and I'm now at the age that I want to get rid of my shares and cash out, and somebody else is going to buy them. Can I use something like this RCA to do this?
Where it's used primarily with sale of a business these days. We used to see it with asset sales of a business, but some of the income, the way that it's been recharacterized, that it's not quite the necessity it used to be. But in terms of a share sale, and I can give you a real world example. We had a couple that were looking at selling the shares of their company in the next 12 months. They didn't have a buyer set up within their corporation. They didn't have a holding company or an additional company where they could send the passive tax paid assets to. So when you have a certain amount of the assets within your corporation that are passive and just are receiving investment income and are not used for operations, once you get over a certain level of that, it can impede the individual's ability to utilize what we call the lifetime capital gains exemption. So that's, I don't have this year's numbers in front of me, but let's say it's around $800,000, where when I sell the shares of my corporation, that $800,000 of that is going to be received tax-free through that lifetime capital gains exemption. But if I have too much passive income being generated within the corporation, it can impede the ability to utilize that $800,000 capital gains exemption. And so what we did in this scenario was we had a couple, they had about $1.5 million of passive assets that would be throwing them offside. They each had received a pretty healthy equal income over the last 10 years, that we had more than enough money to absorb that 1.5 million. The company did the contribution on their behalf, $750,000 each account. We've now purified the corporation so that they can sell it with being able to preserve that lifetime capital gains exemption for themselves. And, they can take the money out when they see fit from the RCA.
So you're saying that you should probably try to do some of this planning prior to even finding a buyer.
It is a consideration. And what I find that unfortunately tends to happen with sales of a business is people will come to us after the transaction's already closed. And if it's a share sale and it's closed, there really isn't a lot of benefit there to try to recharacterize what would be a capital gain as taxable income, because as you know, there's a 50% capital gains inclusion rate right now. So if I have $100,000 of a capital gain, it's really $50,000 before I attach the taxes to it. So there wouldn't be that much of a benefit to instead put that into a registered plan that is going to be payable at income rates.
Yeah. Okay. Yeah, I that was all so informative. I really appreciate some of the things that you've told us about today. I know there's a lot of people that are probably on this call right now that are like, I don't get it.
Well,
so I wanted to, yeah. So
what I was going to say is, and this isn't just because this is part of the work that we do, but I think that the RCA is the least understood planning and most powerful planning structure out there due to the flexibilities involved in it. I think that they were marketed in the wrong way in the past, where it was more looking at it as an insurance product, but we don't look at it from a perspective of the investment. We look at it from the perspective of the tax planning, and based on that planning, what is going to be a suitable investment is going to just make sense. So in the majority of the cases we don't use insurance as an investment vehicle anymore, just due to the flexibilities. So I think it's especially with tax rates being as high as they are, I think it's a good idea, for a business owner and perhaps their tax professional to have a second look at this.
Yeah, yeah. Actually, talking about taxes and having that investment account, what type of investments should people be putting in this investment account? Like, are we looking at just buying shares of companies or bonds or like real estate? What would be the best way to invest the investment account portion of the money without?
Well, I mean, they would have to be third-party investments. Like you couldn't go buy a house or a personal property with it. What you want to keep in mind is, unlike an RSP or or a pension plan, that what happens within an RCA is if you have any realized capital gains, dividends, or interest paid into the trust in that given year, you're not taxed on it, but it is subject to refundable tax. So that 50% I mentioned earlier that sits with the government. So if I have, $20,000 of dividends, let's say at the end of the year, I'd have to remit 10,000 of that over to that refundable tax account. I'm going to get the money back down the road, but I'm going to have to remit it. So it's not a requirement to use tax efficient investments, but we tend to see a lot of people utilizing them to reduce that. So it could be things like corporate class funds. It could be certain types of ETFs, things that aren't necessarily spitting out income. Obviously, a lot of things that have return on capital make sense because of the tax efficiency. You can use, something like a universal life policy, but you have to be really careful about split dollaring it. You don't want the insurance owned by the RCA because upon death it would be taxable. And but the cash value you could use as an investment vehicle because it's tax deferred. I just think that for a lot of planning, you have to have a really long time horizon there to use insurance. Like you have to not need the money for at least 10 years for it to work. So I think to have traditional investments in there that are tax efficient just buys you a lot more flexibility because this year you might say, I know what's going on. We don't know 3 years from now, and maybe 3 years from now you sell your company and you want access to the capital.
Yeah, no, totally. So if you're a business owner and you're thinking about something and you're trying to, reduce taxes and you're thinking about the future, maybe it's time that we have a conversation. Obviously, Fraser can join in on the conversation with your accountant and us, and we can have a good conversation about this type of planning tool so that we can reduce taxes. Fraser, thank you very, very much for the information you provided for us today. I know it probably went over a lot of people's heads, and that's normal. Even went over my head the first time I heard about this thing. So thank you. Do you have anything else to add?
I think that you have a lot of unique professionals that you leverage on your side, and I think there's some great advice there. So I hope that people do reach out and look at some of these alternatives that both you and Schick are able to offer up to your clients, because I think that there's a lot of great advice that can be provided.
Yeah, thank you very much, Fraser. I guess I should just put it out there. Our number is 905-849-3549. If you have any questions, feel free to give us a call and we can book a meeting. Thank you very much, everyone, and we'll see you in 2 weeks.
All right, everyone, stay safe, and thanks, Sheean.